once we select a stock that's on a 10-month simple moving average buy signal and it's trading in the Keltner channel buy zone, we next have to select an option strike price. So depending on the stock, there could be hundreds or even thousands of strike prices to choose from. So the question becomes, how do you determine which strike price to trade? And selecting the strike price can be just as important as the stock selection itself. So option premiums consists of time value and intrinsic value. And if we add the time value to the intrinsic value, we get the total option premium. And each day before option expiration, the time value portion of an option decays. And the greatest amount of time decay occurs in the last 30 days before option expiration. And at expiration, options lose all time value and consist of only intrinsic value. So here's a typical time decay characteristic of an option. This line right here represents the time value portion of an option, and we can see that each day that time value portion decays, and the most rapid decay is 30 days before option expiration, and at expiration options lose all time value. So options lose all time value at expiration and consist of only intrinsic value. So when you buy an option, you're buying a decaying asset. And due to the time decay characteristics of options, we want to minimize that time value because it's going to decay to zero, and we want to maximize intrinsic value. And the best way to minimize time value and maximize intrinsic value is to purchase in-the-money options. In-the-money options have more intrinsic value and less time value than at-the-money or out-of-the-money options. And of course, in-the-money options have strike prices that are lower than the current price of the stock. So I developed a simple technique I call the 1% rule for selecting an in-the-money strike price when purchasing options. And the 1% rule utilizes a strike price that limits the time value portion of an option to less than 1% of the stock price in order to minimize time value and maximize intrinsic value. So we want to see a time value that's less than 1% of the stock price. Now, if you limit the time value portion of an option to less than 1% of the stock price, the stock only needs to increase 1% in order for the option trade to start profiting. So it only requires, when you use the 1% rule, you only need a 1% move in the stock to start profiting on the option. So a 1% stock price increase to profit is going to have a higher probability of being profitable than an at-the-money or out-of-the-money strike price that can require up to a 5 to 10% or greater price increase at option expiration just to break even and start profiting. So many times the expected stock price move will not occur before option expiration. And remember, if you purchase an at-the-money or out-of-the-money strike call option and the stock or ETF is flat or down at option expiration, it will result in a 100% loss for your option trade. So if the stock closes at or below the strike price of a call option at expiration, then you'll lose the option premium. So when we use this 1% rule, the option intrinsic value will increase $100 for each 1 point increase in the underlying stock. So let's look at calculating the time value and intrinsic value. And here's a snapshot of the GLD option chain. At the time, GLD was trading at 142.78. Let's look at the GLD 130 strike call, which I have highlighted right here. And the 130 strike is less than the current ETF price, so this is an in-the-money option, and these options expire in about 2 months. We can see for the 130 strike call, in this at the time, the bid price was $13.35. The ask price was $13.50. So if we're buying the option and we use a market order, we could expect to pay the ask price. In this example, it would be $13.50. So when we're looking for an option strike price that meets the 1% rule requirement, we generally look for a strike price that's about 8 to 10% or more below the current stock price or ETF price. So when you're searching for an option that qualifies, you can start at around 8 to 10%, a strike price that's 8 to 10% below the current stock price. So in this example, the 130 strike call is about 9% below the current GLD price of 142.78. So in this case, the in-the-money 130 strike call is about 9% below the current stock price. So to calculate the intrinsic value, we subtract the strike price from the current stock or ETF price to calculate the intrinsic value. In this example, we subtract the 130 strike from the current ETF price of 142.78, and we come up with a intrinsic value of 12.78. And to calculate the time value, we subtract the intrinsic value from the option premium, and that will give us the time value. So in this example, the option premium was $13.50. We calculated the intrinsic value to be $12.78. So if we subtract that $12.78 from $13.50, we come up with a time value of 72 cents. So the GLD 130 strike call has 72 cents of time premium. So let's use the 1% rule on this 130 strike call, and 1% of the ETF price of 142.78 would be $1.42. So in order for the strike price to qualify for the 1% rule, the time value portion of the option would have to be less than $1.42. So with the GLD trading at 142.78, we would limit that time value portion of the option to less than $1.42, which is 1% of the current ETF price. So the 72 cent time value is less than 142, so this GLD 130 strike call would qualify under the 1% rule. And in this example, GLD only needs to increase 72 cents for the trade to break even and start profiting. So in this example, if we purchase the 130 strike call, GLD only has to increase 72 cents and we'll start profiting on that call option. So a 1% price increase to profit has a higher probability of being profitable than an at-the-money or out-of-the-money strike price that can require up to a 5 to 10% or greater price increase at option expiration to profit. So this is strictly a mathematical calculation, and a 1% price increase to profit will have a higher percentage of trades than an at-the-money or in-the-money strike that requires a bigger price move in the underlying stock to break even and start profiting. So using that 1% rule to select an option strike price will increase your percentage of winning trades compared to trading at the money or out of the money strike calls, and this higher accuracy can give you the discipline needed to be a successful options trader. Now, I designed an online calculator that will calculate the profit potential for a call option purchase before commissions, and the calculator will calculate the profit loss potential for a call option purchase before we take the trade. So before we take an option trade, we'll plug in the current prices for the option into our calculator, and that way we can determine the profit potential or loss potential before we take the trade. And the calculator will calculate the profit potential for a call option purchase based on the price change in the underlying stock or ETF at option expiration. So let's look at our GLD example again. GLD trading at 142.78. The 130 strike call has an ask price of $13.50. So if we enter the current ETF price 142.78, the strike price of 130, the option premium of $13.50 into the calculator, it will calculate the profit loss potential. And in this example, we will assume the GLD price changes at option expiration are from flat to a 12.5% increase. So with GLD trading 142.78, we could purchase the 130 strike call, $13.50, and then we put the assumptions in this top row for the price changes of GLD at option expiration. And when we click calculate, the calculator will calculate the profit loss potential, and the bottom row right here is the percent gain for the option corresponding to the change in the top row here. So if the GLD is flat at option expiration, the option will lose 5.3%. And the second row from the bottom lists the dollar profit or loss for the option trade, again corresponding to the price change in GLD in the top row. And the calculator will also calculate the time value and intrinsic value of the option. In this example, the 130 strike call has a 12.78 intrinsic value, 72 cents time value. So we can see that if GLD remains flat at option expiration, I'm getting a little bit ahead of myself here. If GLD remains flat at option expiration, we lose 5.3%. It's hard to see here. I'm at the bottom of the slide, but we lose 5.3%. And remember, if we purchased an at the money or out of the money call option and the stock is flat at option expiration, it will result in 100% loss of your option premium. So in this example, the with a flat stock price, we're going to lose 5.3% compared to 100% loss if we had purchased a at the money or out of the money strike. And we also plugged in a 1% move in GLD, and we can see that if GLD moves up 1% from 142.78 to 144.21, it will result in a 5.2% profit. So our 1% rule requires a 1% move in the underlying stock to produce a profit. So this confirms that the strike price, the 130 strike price that we selected, complies with the 1% rule, because if the GLD is up 1%, we're going to have a 5.2% profit in the trade. Now, there's no limit on the profit potential of a call option purchase if the underlying stock or ETF continues to move up in price. So there's no limit on the profit potential. If GLD moves up 5%, we'll realize a $642 profit and a 47.5% return before commissions. And if GLD moves up 10%, we'll realize a $1,356 profit and a 100% return for the call before commissions. So no limit on the profit potential of a call option purchase. You can see as the underlying stock moves up in price, then the profit potential of the option also moves up. So that concludes the presentation for today. If you'd like to contact me, you can call 831-622-9644 or email me at support@chuckhughesic.com. So